Hello, everyone, and welcome to your Onchain update for the 12th of October. So, what I want to explore today is whether Bitcoin is undervalued. And to kind of answer that question very quickly, the answer is yes, it is. But what I want to do is put some actual quantification below that so you can just see across a whole suite of metrics, some of them on chain, some of them technical, just get a bit of a gauge for where we kind of sit in this whole mix. What does undervalued mean? How do you quantify it? And just give you a bit of a gauge with some numbers associated with it. So we're going to compare numerous models, and really what we're looking for here is deviations from the norm. And the question is, what is the norm? Well, the answer is nobody knows. That's why prices are always moving around. But what we have is a series of tools that give us these long-term means: 200-day moving averages, realized prices, cohort behavior, profit and loss, all these types of things. And I'm going to use a tool that I'm just calling days below. And what I'm essentially doing here is looking at where are we right now. If we look at the current levels for a whole suite of metrics, what is the current value, and thus how many days in Bitcoin's history have we been below that level, presented as a percentage. So if you're looking at 1, 2, 5, 10%, that means that 90% or 99% of all days have been above this level, meaning we're in a pretty improbable spot. So that's the framework, and we'll touch on it from a few different angles, but let's get started. So the first one that we're going to look at is the investor tool, and this is something that Philip Swift put forward some time ago. Really, there's no magic to this. This is essentially the 2-year moving average, and then multiplying that 2-year moving average by 5. Sadly, we don't need the red line because we are not at the top. We are closer to the bottom. So what I've done here is you can see that during bear markets, we spend most of the bottom formation below it and for some time. So really what we're looking here is just a very, very big picture. Where are we in typical bottom formation? So this oscillator here is, as you can see, goes through these obvious peaks. And as we get below it, it obviously descends to very low values. Now, where we currently sit is extraordinarily low. We've basically never been this low before in terms of a deviation below this particular model. Now, again, this is just a simple 2-year moving average. We're obviously going to add more complexity, but what I want to take away from this is confluence. When do we actually have multiple metrics telling us the same story? There is no one model to rule them all, so we're really looking for confluence across a whole bunch of these things. And this one is obviously a very crude model, but we will step it up in complexity as we go. So what this is currently telling us is that we have had 0.08% of all trading days at a higher deviation. What that essentially means, and you can see that the spike up here has been fairly recent, we're at all-time lows, right? This model, we have basically never been that deviated away from it. Now, of course, there's always two takes to these things. Someone will look at this and say, well, that means Bitcoin's broken and the regime is different and the world is over and blah, blah, blah. Sure. But it also looked like that back in 2018, right? Where we were also at that very, very low level. And it would have looked like that back in 2015 for the guy who was looking at this model as well. So yes, that's true. We are at a very, very low level. It could mean that the world is broken. We will have to find out. The truth is none of us know. And that's why we look for confluence. But essentially, based on this, we're essentially quite some distance, if not the most, that we've seen more or less since 2015, 2013. So it's been a long time coming. Now, on something that is even more robust than that, because a 2-year moving average is, it's kind of arbitrary, okay? The 200-day moving average, on the other hand, has a whole lot more going for it. And why? Because traders around the world for many, many years have been using the 200-day as a bull-bear bias. And as you can see by the days below curve, note how it typically oscillates. What this basically means is we get down to these low levels and then we recover for an extended period. You can see that we've essentially established somewhat of a baseline. We spend a typical amount of time down at this level, and then we recover. Now, we have been under this level for 10.6%. So we have been at a worse condition for 10% of Bitcoin's life, which basically means that we have 90% of Bitcoin's life that is in a more superior position. So if you think about that from probabilities, if we've only been lower for 10% of the time, that means that if you're willing to weather 10% of the next whatever your time frame is, if you're willing to weather 10% below, then there's a 90% probability that price will recover from this level. So again, we're looking at something that is not the most undervalued it's ever been, but it's also not far from it. We're talking about 90% odds. If you're given 90% odds at a table somewhere in a casino, generally people will take that. So again, it comes down to having the correct time frame. And 10% is clearly not zero. That's 1 in 10. But it's also a hell of a lot less than 90%. So the odds are starting to get into our favor. The risk to reward is certainly looking more positive to the upside. But as we've said through many of these sessions, whatever volatility between now and then is something to just be aware of. So that's two technical models. Now we're going to move into the on-chain space. And again, I really want to focus on getting confluence between these things. We're looking for multiple metrics telling us a consistent story. So when we look at the MVRV, now this is a different variant of the MVRV. What I've done here, and actually let me just quickly duck down so you can see the logic here. Coins that are older than 7 years, we can give a reasonable estimate. We're never going to know for sure, but older than 7 years, they're not economically active. They're not really participating in any meaningful price action. Prices were sub $1,000 back when that was the case. Really, they're not relevant to what we're currently looking at. Right? They're from so far ago. They're going to include Satoshi's coins, early miners. There's a whole lot of lost coins. It's something on the order of about 36% of the supply, or 37.7% of the supply is older than 7 years. So let's remove that from a couple of calculations. When I talk about adjusted, that's what I mean. I'm essentially removing the influence of those 7-year-old coins to try and assess where is the financial pain inside the current set of the market. So the other way to think about this, I actually don't care how much profit Satoshi's in because he's probably not going to spend his coins. So thus, if I remove that from the mix, what is the level of financial pain in terms of unrealized loss held by this market? So that's what the adjusted MVRV is doing. And we are currently at a value of 0.7. Now that means that the average market participant who is not Satoshi and is not a 7-year-old plus coin has a 30% loss on the book. Now that's pretty significant. You can actually see that this is at the bottom of March 2020. This is at the bottom of, or pretty much at the bottom of 2018. And it is at the very, very bottom back here in 2015. In fact, all the way back in 2011 is the only time we spent any appreciable time under this level. So in terms of how many days we've been below this point, 3%. So whereas our Mayer multiple was telling us that we're something on the order of 10%, based on the MVRV and the amount of profitability in the system, once we remove some of those non-economic coins, and just for the record, I'm not removing those coins because I want to fudge the numbers to make it look even more attractive. I think we'd all agree that coins that are older than 7 years, I mean, who actually cares? Until they get spent, at which case, by the way, they would revalue this metric, so it's kind of self-adjusting. Who really cares? I mean, I'd love to hear a case as to why we should care about them. If they get spent, this metric will adjust and then we can account for them. Until that point in time, I think it's reasonable to basically say that they're not useful. And in many ways, they're actually going to cause a skew if you don't account for them. So anyway, 3% of trading days have been in a worse position. We're now talking about 97% odds that the market wants to be in a more healthy position. Again, 97% are pretty good odds anywhere that you look. So again, we start building up this confluence. We've now got one metric was basically all-time lows. Mayer multiple, somewhere on the order of 10%. Here we're talking about 3%. This is starting to look reasonably healthy. Now that was the standard MVRV with adjustment. If we then back off and look at all of our cost bases, we've got our all market, we've got our long-term holders and our short-term holders. If we look at those particular models, where do we currently sit? All right, we've only been underneath all three of those models for 11.8%, so let's just say 12% of trading days. Aligns with the Mayer multiple. We're sitting in that realm of 90 to 88% probability that price wants to get above this level. We are not below these metrics for very long. And the other thing that we saw happen this week is that the short-term holder cost basis dive down below the long-term holder cost base. I'm just going to zoom in on 2015 and 18 so you can see what this looks like. The red curve has dived down below the blue curve. Now, why does this happen? It happens at capitulation points because a whole bunch of long-term, short-term, mid-term, all sorts of people flushed out during the capitulation. Their cost basis gets driven down to an extremely low level, and thus people who entered the market in the last 5 months have a better cost basis than people who've weathered all the volatility, right? Everyone who stuck around through this cycle got absolutely smoked. And what we're seeing is that people who are entering this market in the last 5 months now have a superior cost basis by about $1,000 or $1,300. So it's kind of ironic, right? That people who can just, hodling in the other sense, meaning being patient and just waiting for the correct moment. Well, what we're seeing here is that this could very well be one of those few correct moments, with 88% of all history saying that it's not a bad idea. So now transitioning over to lifespan, right? So we're looking at both the value of the coins that are destroyed multiplied by the age of those coins. Now, this is a multiple that was developed by the illustrious TXMC. So this is a fantastic metric which combines, it's basically like a time and volume weighted oscillator. Now, as you can see, we've tried to color code this thing with red being all-time highs and peaks, yellow being somewhere in the middle, and these green zones, I mean, you can see that we're pretty much at all-time lows. We occasionally get down to these very, very low points during bear markets. They're not necessarily bottom pickers. And in fact, you'll probably see a spike near the bottom because lots of old coins panic as well. Nevertheless, when we look at this general area of where we currently sit, again, 10% of all days have been at a lower level than this. We are in extreme hodl territory. So we've now got pricing models, we've got hodling behavior, we've got profitability, all signaling, at the very least, at an upper bound, 10% probability of going lower, meaning 90% probability of going higher. If we look at our supply in profit as a percentage, so again, this is why we actually started adjusting for this, because if you look at the yellow curve, you can see there's this gradual uptrend over time, right? This is because Satoshi's coins are always going to be in profit. So thus, you've already got a percentage of the supply, right? 1 million out of 21 million, who are just always going to be in profit, right? Plus all the early miners and all that kind of stuff. There's somewhere between 4 and 5 million coins that we believe are just like lost. So they're always going to be in profit, and therefore you're going to have a natural gradient to the upside. So let's subtract those out and let's see how much pain is in this market. What you can see is that we are currently sitting underneath March 2020. March 2020 had superior profitability at the bottom than we have right now. And in fact, only 2.9% of all trading days have been worse off than where we currently are. 2.9% is a very, very small probability when you're looking at markets. And it very much aligns with, what was the other metric we looked at, the MVRV. So on a profitability standpoint, the market has been in a superior position on a profitability standpoint 97% of the time. It really is quite remarkable. You just don't see these numbers very often. Bringing that into the net unrealized profit and loss, this is kind of a blend between the markets, the MVRV and supply and profit. Again, we have adjusted this thing down, taking out those 7-year-old coins, and we are sitting somewhere at 5.2% of all trading days being in a worse position. So, again, we're really seeing this 10% to 90 to 95% of all trading days being above where we currently are, starting to look like a bit of a sweet spot, right? There's a few metrics that are all pointing to a very, very similar reality here. And the last one I want to close in is of the percentage of supply. Let's break it up into long and short-term holders. What I really like about this is it's removing the influence of exchanges completely. There's no exchange coins in here. This is purely investor wallets, coins that are not clustered with any kind of exchanges, obviously clustered into long and short-term. We can see that the long-term holders are pretty much at some of their worst profitability. We've got this nice little uptrend. More coins are maturing into this realm. We're seeing this basically increasing all the time. We're up around levels that are similar to 2018 and 2015 at the bottoms. And where we currently are, if you combine both of these, 10% of all trading days have a worse profitability across the board. And really, where are those 10% of days? They are also at the very, very bottoms. So, we are really in this groundwork where it's like 10, 10, 10, 3, 3, 5, when you look at all these percentages. So we really are somewhere that if you look at any kind of statistical basis, any kind of historical argument, undervalued much? Well, the answer is yeah, we're actually extremely undervalued based on pretty much every metric. And it comes down to the thing where, is this time different? It might be. Let's always keep that. And I guess this is where it comes down to handicapping these things, which is the hardest part of investing. What probability do you assign that this time is different? For me personally, when I kind of look at the whole spread of macro and all these things, this time is different in the sense that we have inflation and central banks are fighting it, and they're raising interest rates and all this kind of thing. But that's the only bit that's different. The main bit that's the same is literally everything else. So there's still the same debt. There's still the same cracks in the economy. Or many of the problems that we had in 2008 are just different. They're at the sovereign level or the Australian housing market rather than the American housing market. Like a lot of the risks that are causing these problems and the solution to which will probably be currency debasement, all of these things and the reason why Bitcoin exists and this kind of whole framework, all these things are the same. Technology is still deflationary. The actions that the Fed are taking are deflationary. Recessions are deflationary. All these things are deflationary. And, whilst I believe that inflation is a secular problem, I think that there's going to be all sorts of reasons why with energy and all this type of stuff, shortages, just all those, the fun reality that we have to look forward to. At the end of the day, the central banks kind of have one tool, and that is to debase the currency, prop up their bond market, and try and defend their currency peg. And we're in an interconnected world where all of these things, you can't really have Japan, the European Central Bank, and the Bank of England, all doing quantitative easing whilst also defending their currency by selling treasuries, and the US just be like, oh, that's something strange going on over there on the other side of the world. No, they're all interconnected. All these banks are tied up with each other. They're all going to have to deal with this problem. And I just don't really see too many other options out of this thing. So, when I kind of look at all of this spread, I say, well, yes, there's a few things that are different, but there's a few things that are different every cycle. It's why there's a meme. This time is different. My view is that over the longer arc of time, and by that I'm talking about 6 months plus at this point, over that longer arc of time, I think everything is more or less the same. The problem hasn't been solved. The can has been kicked. They'll probably go for another swing and try and kick it again. And Bitcoin is basically as undervalued as you get it at any point in time. So, as I've said many times, be prepared for that wick. Be prepared for it to go lower. Just have that as part of your framework. For me, I'm fully ready for it. If it happens, it happens. I can't control these things. Sure, I can have some cash on the side and take advantage of it. But I also see value here. And if it goes down to 15K, well, so be it. So, you kind of have to mentally prepare yourself and make those decisions that, be ready for the dip. Also be ready for just taking these numbers and saying, it doesn't happen very often. And then once you factor in your time horizon, right? If this thing wicks down or, trades down there for 3 months and then recovers, any buy under 18K is probably going to make a whole lot of sense over the long arc of time. So this is where I find having the big picture thesis, looking at the macro data. Yes, things can spike up and down all over the place, but what we're looking at here is something on the order of 90 to 95% odds that Bitcoin is in a deep value zone. So take that information, factor it in, factor in the probability of some kind of major macro downturn, which is a significant one, and essentially mentally and financially prepare yourself for all of these scenarios. Anyway, hopefully that's useful. If anything's unclear, I know there's some of these concepts of probabilities and things are unique. So, more than happy to answer questions, and I'll see you in the next one. Cheers.